Hi class, today we're going to look at chapter 21. We're going to talk about cost, volume, profit analysis, and we're also going to work on 21-2B. So I'm going to share my screen with you. I've made some notes that came from the chapter in Excel, so I'm going to share those with you. And what we're going to be talking about today is cost, volume, profit analysis. And basically all that is we're going to be looking at the relationships among selling prices, our sales for the company, production volume, the cost of the company, the expenses, and the profits. We're going to look at relationships. So we're going to look at a lot of formulas today. So I want you to be aware of this chapter has a lot of formulas, so you're going to need to learn most of the formulas that are in here. And what cost, volume, profit analysis does basically is it helps management to set selling prices of their products. It can also help management in analyzing the effect of changes in selling prices on profits. So if management is thinking about raising the selling price, we're going to be looking at formulas that will help us to determine what will happen to the profit if we do raise those selling prices. It can help management in analyzing the effects of changes in the number of units sold on profits. So if we are anticipating a sales increase, we can see how that will affect our profits. If we are planning to sell more units, we want to look at how that affects the company's operating income or profits. And so it also helps management by analyzing the effects of changes in cost on profits. So we're going to be looking at some of those costs that we talked about earlier. What would happen if we change the price of the fixed cost? What would happen to the income? What would happen if we change the variable cost? How would that affect the income of the company? We're also going to be selecting a mix of products to sell. This is what would happen if we have more than one product that we're selling to a company. We would determine what is the best mix of products to sell in order to receive a profit off of the sale of those products. Also, it will help management in choosing between different types of marketing strategies for their company. So cost, volume, profit analysis is important to management in that it helps them to examine the relationships among selling prices, sales, production volume, cost, expenses, and profits. So one of the first formulas that we're going to need to look at is something that we call contribution margin. And what contribution margin is it's the excess of sales over variable cost. So we're going to determine our sales in dollars and subtract out our variable cost, and that will give us our contribution margin in dollar amounts. And then we're going to look at different relationships that we can apply to this contribution margin formula. We're going to turn it around somewhat and use it for purposes that management deems will be important in helping them to direct their operations of the company. So something that's very important in this chapter is for you to learn a new form of an income statement that we just use for management purposes. This is not an income statement that would go outside of the business. This is just one that management would use internally to help them to direct operations in the future. The contribution margin income statement, we're going to start with our revenue, just like we do with an external financial statement. Our income statement begins with the revenue. So sales is still the revenue that you know about. But instead of subtracting out cost of goods sold from our sales like we would do in an external financial statement, we're going to subtract out our variable cost. Remember, we talked about variable cost the last time that we met, and our variable cost are our costs that will vary with the activity level of units that we are producing. So things like direct materials, direct labor, these are examples of variable cost. And it would just depend on the number of units produced as to how much direct materials cost you would incur. So variable costs are the costs that will vary with the production level. We're going to subtract those from our sales revenue, and that will give us a term that we call contribution margin. What contribution margin is the amount that's left over to cover our fixed cost. So this is like a subtotal here. Sales less variable cost gives you the contribution margin, and that contribution margin is what we have left of the sales that will cover our fixed cost. Once we get our fixed cost covered, then we can determine whether we have an income from operations or a loss on operations. So our fixed cost in review were the costs that remain constant in total. They won't change with the level of units produced. Things that we talked about were fixed costs were salaries. So salaries would stay the same no matter how many units are produced. But our fixed costs are deducted from the contribution margin, and that will leave you with income from operations. And this is a very important income statement that you need to learn in this chapter. Now I want to go over an illustration from your chapter to help you with some of these formulas. And we're going to illustrate by being the Lambert Company. And I've got a list here of sales in units. I've got selling price per unit is $20 per unit. Variable cost per unit is $12 per unit, and fixed costs are $300,000. So if we were preparing this contribution margin income statement for the Lambert Company, what we would need to do is determine our sales first, because we know how many units we sold and we know the selling price per unit. If you just multiply your sales in units times the selling price, it will give you the sales in dollar amounts. We're going to subtract from our sales our variable cost. If we know the variable cost per unit is $12 and we know how many units we sold, if you multiply 12 by 50,000, it will give you the total variable cost. Notice these variable costs depend on the number of units sold. So the more units we sell, the higher the variable cost will be. In this case, 50,000 units were sold at $12 per variable cost per unit, which will give you 600,000. The difference between our variable cost and our revenue of sales is what's left over, which we call contribution margin. This is the contribution margin in dollar amounts for the Lambert Company. Their contribution margin is $400,000. Now we're going to back out our fixed cost. Our fixed costs were given to us at $300,000. So the difference between my fixed cost and my contribution margin is the income from operations. So if this company sells 50,000 units at a selling price of $20 and it has variable cost per unit of $12 and fixed cost of $300,000, we can expect to have a profit or an income from operations of $100,000. Now the contribution margin ratio is expressed as a percentage. What we did right here is we showed the contribution margin and dollar amounts. You can also show this as a ratio. The ratio is the percentage of sales dollars or the contribution margin divided by the selling dollars will give us the contribution margin ratio, which is expressed as a percentage. It is the percentage of sales dollars available to cover the fixed cost and provide income from operations. So there's a percentage that we would come up with here that would be considered to be the contribution margin ratio, and that percentage is what we have as a percentage of each sales dollar to cover the fixed cost. So the contribution margin ratio formula is this. The contribution margin ratio is equal to the contribution margin in dollars divided by the sales in dollars. So if the sales in dollars the contribution margin in dollars is 400,000, I took that right off of the income statement here. If we divide it by $1 million in sales, that will give us our contribution margin ratio. The contribution margin ratio for the Lambert Company is 40%. So contribution margin divided into the sales will give you 40%. And sometimes they show it out to the side of this contribution margin income statement. So in other words, this 40% would show up right here as the contribution margin ratio. Oh, I'm sorry, I put that beside the wrong figure there. Let me stick it up here where it belongs. It would belong right here, 40%. And the way that I got that 40% is you take your 400,000, I'm going to create a formula here so you can see it, and divide it by the sales. The 400,000 is the sales. The 400,000 is the dollar amount of the contribution margin divided by the dollar amount of the sales. That will give you 40%. That's how I got that. If we wanted to know what the variable cost percentage is of sales, what we would do is the same thing, except we would use the total variable cost and we would divide that by the sales. And that would give you the variable cost percentage, which is 60%. So this is 60% here. Our sales divided by itself is 100% or 1. If we take the sales and we divide it by the sales, it will give you 1, which is equal to 100% if you changed it to a percentage. So what we need to know is the relationship between these numbers. So sales is always equal to 100%. If sales is equal to 100%, then my variable cost percentage will be equal to 60%. And that's because 600,000 divided by 1 million is 60%. If I know what my variable cost percentage is, then I can subtract it from 100% and it'll give me 40%. So there's a relationship between these amounts here. Does that make sense to you? And so this is a percentage, if you want to think of it like that. Or you could also think of it as ratios. And this is how we did it here. All right, so getting back to where we were before, the contribution margin ratio is 40%. The contribution margin in dollar amounts is 400,000. And so the reason that we can state it as a ratio is because it'll give us kind of a shortcut method in arriving at income from operations. It's most useful to calculate the change in income from operations due to an increase or decrease in sales dollars, or we could use sales units, assuming the variable cost per unit and the sales price remain the same, they remain constant. We can do this instead of having to use the entire contribution margin to determine the change in income. So these ratios are used to find shortcuts to help us to determine what our income from operations could be if we change the dollar amount of our sales or the number of units of our sales. The contribution margin ratio is useful in helping management to develop business strategies for the company. If you have a company that has a high contribution margin ratio that is operating below 100% capacity, as an example, so what this means is if they've got a high contribution margin ratio that they came up with for this company, but they weren't actually producing the total capacity units that they could produce in that company. If they were producing less than 100% capacity, then it might be a good idea for management to try to advertise or do some kind of sales campaign to help it increase its sales, which will in turn increase the dollar amount of the income from operations. Or if you were using as an example a company that had a small contribution margin ratio, they might, instead of trying to advertise more and get a better sales campaign going, they might just attempt to reduce the variable cost to get them a higher amount of contribution margin ratio that would contribute to a higher amount of income from operations. So we're using these formulas to help management to make decisions about their company. You can also find a unit contribution margin, and a unit contribution margin is basically the same thing we've done here, except we can find a unit. And in this problem, they gave us a sales price per unit. So if I want to make a category per unit here, if we know the selling price per unit is $20, that was given. If we know the variable cost per unit, which is $12, that was also given here, we can determine the contribution margin per unit by subtracting the variable cost per unit from the selling price per unit. So if we took $20 as our selling price and we subtracted our variable cost per unit, that would give us $8 as our contribution margin per unit. Now, there's a relationship between these items here, and I want to show that to you in starting with the selling price per unit. So if we know the selling price per unit is $20 and we know the total sales is $1 million, you can find the units sold too, or units produced if that's what they're asking you for. But let's say it's units sold, unit sales that we're going to put here. And I can find that by simply taking my total sales figure here and dividing it by $20 per unit. And that will tell me And that shouldn't be a dollar sign there. That's something that Excel does. So hang on just a second. Let me see if I can get that dollar sign off of there. Well, I know what I'll do. I'll just enter it in like this. So equals is my formula. I'm going to start the formula and I'm going to put in 1 million without a dollar sign here. And I'm going to divide that by $20, which is my selling price per unit. And that, I don't want the dollar sign in there. Why is it doing that? Let me see if I can change it here. There we go. This is units. This is what I wanted here. It's 50,000 units. It still is even number of units there. All right. If I do the same thing here, if I take and create a formula and I take the variable cost total and I divide it by my variable cost per unit, it should also give me 50,000 units. And again, let me change that to general so it will show as units there. That's just an Excel thing there. So in other words, if I divide 8 into 400,000, it's going to give me 50,000 units that I sold. So there's a relationship between all these numbers. 50,000 units times $20 is $1 million. It's also 100% of sales. 50,000 times 12 is 600,000. And 600,000 is 60% of the sales figure. So there's a relationship between these numbers. And I think you need to be able to see that relationship when you're doing the problems, when we're going to be working on the problems for this. But getting back to the unit contribution margin, our unit contribution margin is $8. That's what the unit contribution margin is. And again, we could take that, I don't know why that's happening there. I hope you couldn't see that, but maybe you did. Anyway, the unit contribution margin is found by taking the selling price per unit and subtracting out the variable cost per unit. And the unit contribution margin is also useful to management. It's useful when the increase or decrease in sales in volume is measured in sales in units. The change in sales in units can be multiplied by the unit contribution margin to get the change in operations. So there's a shortcut formula that you can do without having to put everything back through this contribution margin income statement. All right, and so the next thing I want to talk to you about is there's some more mathematical approaches to what we call cost volume profit analysis. And there's, as I see, I've got a misspelled word here, so bear with me. There's a mathematical approach to using equations that will help us to determine the necessary sales to break even. And what by break even or the break even point is the level of operations at which a company's revenue will be equal to its expenses. So there's a formula for break even that you need to become aware of. At break even, the formula is going to be this: break even sales in units, and let me emphasize that we're talking about units here, is going to be equal to your fixed cost divided by the unit contribution margin. So if we wanted to determine break-even sales in units, the number of units that it takes for us to break even, where we're not making a profit, we're not making a loss, we're just breaking even, we can use this formula to help us to determine what the break-even sales in units are going to be. And we're going to use this formula in one of your homework problems that you're going to have to do in this chapter. And I'm going to do an example of a homework problem that uses the break-even sales in units so that you can see how to do this. I just mainly wanted you to be aware of there's formulas that you're going to have to learn in this chapter, and I want to emphasize these formulas with you. You can also calculate break-even in dollar amounts of sales. And the formula is very similar. As you can see here, you're still taking your fixed cost, you're still dividing it by a contribution margin, but this time notice the denominator has changed to ratio, whereas before this was the unit contribution margin. We're going to use the contribution margin ratio, and that will tell us the sales in dollars that we have to use in order to break even. And so break even can be analyzed by changing your fixed cost. The effects of changes in fixed cost on the break-even point are this. If you increase your fixed cost, the break-even point will also increase. If you decrease your fixed cost, the break-even point will also decrease. So anytime you increase fixed cost, you can expect that your break-even point is going to increase. If you decrease your fixed cost, your break-even point is going to decrease. We can also measure the effect of the changes in unit variable cost on the break-even point. And it's basically the same as what happens with fixed costs because they're cost. If you increase, have an increase in cost, you're going to have an increase in break-even point. If you decrease your cost, then your break-even point units that you have to sell will decrease. There are also effects of changes in the unit selling price on break-even. And so if management decides that they're going to change the unit selling price, they're going to increase the unit selling price, then what that means is they're going to charge more, so their break-even will decrease. The number of units that they have to sell to break even will decrease if you have an increase in your selling price. If you are going to decrease your selling price, then you're going to have to sell more units to break even. And so management is going to use some of these formulas to help them to make decisions about how they should operate the company. Also, if management wants to get a target profit, all they have to do is modify the break-even formula, and you can determine the sales in units that you'll need to have to get that desired profit. And this is the formula that they use for target profit. Notice this says sales in units. Sales in units is going to be equal to your fixed cost plus your targeted profit divided by your unit contribution margin. What that would do is tell you how many units you had to sell in order to meet that profit, that desired profit. You could also change up the sales dollars. So if you want to know how many sales dollars you had to make, the formula becomes fixed cost plus targeted profit, just like it was before to start with. But notice they changed the divisor to contribution margin ratio. The ratio will give you the sales in dollars that you need in order to make that desired profit. So all of these are formulas that you need to become familiar with. And there are just a few of them. There's some more formulas in this chapter that we're going to talk about later on. But what I want to do is give you enough of the formulas to be able to solve problem 21-2B. So I'm going to switch sheets. If you look at my spreadsheet down here at the bottom, if you just click on that, I'm going to go to chapter 21, problem 2B, and I'm going to work this problem with you. What we're doing is we're going to be determining the break-even sales under present conditions and also proposed conditions for this company. We're going to be Howard Industries, and we are operating at full capacity, which means they're operating at the most capacity that they possibly could. And while they were operating at this full capacity, they sold 64,000 units at a selling price of $45 per unit. And that's what happened during the current year. And so its income statement was as follows. This is an external form of an income statement. Remember, we talked about doing the contribution margin income statement, which they're going to have you doing a little bit of, I think, and if it's not in this problem, it's in the next problem. But this right here is an external income statement that they have prepared. That means it's going to go outside of the business, and it's not the contribution margin income statement that we talked about earlier. This is one that you should already be familiar with. And then they gave us some more information in this problem about how they divided the cost between variable and fixed cost. So notice they gave you a column for variable, and they said that, well, they have some costs that make up variable cost of goods sold as 75%, and the 25% is fixed cost. The selling price, there are some selling expenses, 60% of those are for variable cost and 40% are for fixed cost. And of our administrative expenses, 80% of those are variable cost and 20% are fixed cost. And then they also tell you that management is considering a plant expansion program for the following year that will permit an increase of 900,000 in yearly sales. So they're thinking about doing a plant expansion that's going to increase the yearly sales by 900,000. The expansion will also increase the fixed cost by 212,500. So that means when we expand the plant, we're going to have some fixed costs that are going to remain constant, but the fixed costs are going to increase in this plant expansion by the amount of 212,500. And then it gives you an important piece of information here that says it will not affect the relationship between sales and variable cost. So the selling price per unit is going to stay the same, and the variable cost per unit is going to stay the same here. What they wanted you to do first is to determine the total fixed cost and the total variable cost for the year. So what I did is I made a column for variable cost and I made a column for fixed cost. And I started by putting in the costs that were going to be part variable and part fixed. Cost of goods sold, selling expenses, and administrative expenses. Now, to determine the variable cost, what I had to do is I had to multiply 75% of my cost of goods sold by the cost of goods sold figure of 1,400,000. If you multiply 75% by 1,400,000, it will give you total variable cost of goods sold of 1,050,000. And so 25% of those were fixed cost. So 25% times 1,400,000, our cost of goods sold, will give you 350,000. We're going to do the same thing for our selling expenses. We're going to take the variable percentage, 60%, multiply it by the selling expenses, which was 400,000. And that will give us our selling expenses. So our selling expense variable cost percentage is 60%. That would be multiplied by the selling expenses. And that will give us our variable portion of the selling expenses. The fixed cost portion is 40% of the selling expenses. So 40% times the selling expenses will give you your fixed cost portion. Your administrative expenses are broken down to 80% variable. So 80% of or times my administrative expenses of 387,500 will give you the administrative expense variable cost. The fixed cost is 20% of the administrative expenses of 387,500. And then I simply totaled these up. My total variable cost are 1,600,000. My total fixed cost are 587,500. In the second part of this problem, they wanted you to determine the unit variable cost. And they also wanted you to determine the unit contribution margin for the year. So for A, to determine the unit variable cost, you're going to need to know what your total variable costs are, and you're going to divide it by the sales in units. That will give you the variable cost per unit. So if my total variable cost is 1,600,000, if I divide this 1,600,000 by the number of units that I sold, which was given here at 64,000 units, that will give me $25. So to determine my unit variable cost, I need to know what my total variable costs are, which we figured in part 1, and I would divide that by my sales in units, which was given at 64,000 units. To find the contribution margin for the current year, I would take my selling price per unit, which was given at $45, and my selling price per unit was given right here at $45. I would subtract out my variable cost per unit, which I found in part 2, which was $25. And the difference will be the contribution margin per unit. So if I'm calculating the contribution margin per unit, this should have per unit here. This is how we would calculate the contribution margin per unit. Also, in this problem, they wanted you to compute the break-even sales in units for the current year. Notice I'm emphasizing units for the current year here. Break-even is where our revenue and our expenses are equal. There's no profit or loss. They want to know how many units they have to sell and so that they won't have a profit or a loss. And the break-even sales in units is your fixed cost divided by your unit contribution margin. The number of units that we have to sell to break even are 29,375. So we must sell 29,375 units in order to be able to break even for this company. In part 4, they want you to determine the break-even sales in units under the proposed program for the following year. So you'll remember under the proposed program, what they said that they were going to do is they were going to have an increase in yearly sales, and they're also going to have an increase in fixed cost. So when we are computing the break-even sales in units under the proposed program, we're going to need to know what the fixed costs for the year are going to be. So the fixed cost for the current year was $587,500. We're going to add to it the expansion increase in fixed cost, which was what they gave you here. There was an increase, I'm sorry, it's here. There was an increase in fixed costs by $212,500. That's where I'm getting this figure here. When you combine what the costs were before the expansion and the costs that were incurred after the expansion, then that will give you the total fixed cost of the proposed program, which is $800,000. These two are added together to get the $800,000. And then what you'll do is you'll take your fixed costs, which are now $800,000, and divide it by the unit contribution margin, which is still $20 per unit. And that will give you 40,000 units that you need to sell in order to break even for the proposed program. In part 5, they want you to determine the amount of the sales units that would be necessary under the proposed program to realize a targeted profit of $692,500. They want you to realize this $692,500. So this is an example of where you're going to have to find the break-even sales in units for a targeted profit. And to determine the number of units that you, I guess you shouldn't call it break-even sales in units, but you should just call it sales in units. The number of units that you have to sell in order to meet this profit of $692,500. You can use the formula that is similar to the break-even formula in that we're going to take our fixed cost. The only difference is we're adding our targeted profit to our fixed cost and then dividing it by the contribution margin. And that's going to tell you how many units you have to sell in order to get or to realize an income of $692,500. Now in part 6, they want you to determine the maximum amount of income from operations that is possible with the expanded plan. And so what you have to remember about the expanded plan is that we're going to have, when we expand the plant, we're anticipating that we're going to sell more units and have an increase in sales dollars of 900,000. So what you would have to do is determine the total sales with the plant expansion first. And the sales in dollars before the expansion was $2,880,000. They gave us the figure of 900,000 as an increase in sales that they think they're going to have because of this plant expansion. So the total sales dollars is $3,780,000 with the plant expansion. Also, if we kept the selling price per unit the same as they told you that there's not going to be a change between sales and variable cost. So our selling price per unit is going to remain the same. If you were to divide that selling price into the total sales dollars, it will tell you how many sales are in units that are going to be required for this company to be able to determine the maximum amount of income. And so your contribution margin income statement will help you to determine what the maximum amount of income from operations would be. So remember, the formula is your revenue would have to be recorded first, and that sales revenue is the sales before the expansion plus what we anticipated in sales increase with the expansion, or the total amount here of $3,780,000. I just brought that down. What will change here is your variable cost. Your variable cost per unit remains constant. You remember your variable cost per unit rules that we talked about the last video that I gave to you, were that the variable cost per unit would remain the same. So this variable cost per unit of $25 stays the same. So the variable cost per unit is going to be $25. But what's going to change is the unit sales. We now need to sell 84,000 in units because with the plant expansion, we were anticipating some more sales dollars. So my variable cost per unit times my unit sales will give me my total variable cost. And so my unit sales times my variable cost per unit here will give you $2,100,000 as variable cost. Once you have your variable cost, you can find your contribution margin by subtracting your variable cost from your sales. And then you're going to determine your fixed cost. Now remember, this is an income statement for the proposed expansion, which means that we had additional fixed cost because of the expansion, and our total fixed cost now with the expansion are $800,000. So when we subtract our fixed cost from the contribution margin, it will give you the income from operations at $880,000. So this is kind of like what management would use to help them to determine whether or not they need to expand the plant. How would it affect their income from operations? And their income from operations would change to $880,000. So before it was $192,500. And now we think that we could get more income off of that plant expansion. So in part 8 is asking you, well, based on that data given, would you, okay, I skipped ahead, I'm sorry. Let's go to 7. If the proposal is accepted, this is a what if the proposal is accepted and the sales remain at the current level, that means we expanded the plant, but our sales in dollars did not change. The sales in dollars would be the same as they were before the plant was expanded. What will the income or loss from operations be for the following year? So our sales is $2,880,000. That's the same sales that was before the expansion. We're saying, well, what if just because we expanded the plant, we didn't have an increase in sales? What would that do to the operating income? Or would there be any operating income if that were the case? The variable cost for the proposed expansion would be the same as what we calculated before. The variable cost would be $1,600,000. That's what they would be before the expansion. And the contribution margin then is the difference between these two, and our fixed cost went up. So this is our income from operations here. And so the income from operations is $480,000. Based on the given data, would you recommend accepting that proposal? And they gave you a list of choices here to choose from, and the correct answer is B. Yes, you should go ahead and move forward with the proposal, because even if you didn't increase the sales, you still had some income from operations. The chances are that if you expand the plant, that your sales will increase. So that can only add to the income from operations. And so that's all I wanted to talk to you about today. And we'll continue this conversation with cost volume profit analysis in a later video. So we'll stop sharing this with you. And we'll see you next time. Bye-bye.